Hello, my peeps. How you doing? Got a little video to kind of lead you through this Unit 4, Number 7, Economy of the 1920s lesson, just to give you an idea on what it's all about. There's a couple things you can start out here, and you don't have to go through this as you watch the video. Obviously, I just want to give you an idea of what you're going through and a couple key points I really want you to get out of it. This first part here, you can match them up. If you go down to the bottom of the page, you'll see the answers there, so you can see how they match up. But take a look at, match up the letters and the numbers with what you think it should be, and then afterwards go to the bottom of the page, you'll see the answers. But here's some terms you should know, and I see my picture didn't show up. It was a bull. And it's bull market and bear market. And it's actually really relevant here in 2020 because we had a very much a bull market for a very, very long time. And things have changed a little bit. We're looking at a bear market right now with the current situation here in middle of April 2020. A bull market is a good market, meaning things are, as you can see, going high, people are making money, yada, yada, yada. A bear market is a market where prices are low, and like it says, and people losing money and whatnot. I always joked, and I apologize to the Chicago fans here, but I always joked, the big joke back in the 90s especially was the bull market. You think of the Chicago Bulls because they were really good, Michael Jordan, right? And you think of the bear market where things are not doing so well. You think of the Chicago Bears because they couldn't win a game to save their lives. So if there's any Bear fans out there, my apologies to you. But that's kind of how I've always thought about that. A bull market's good, bear market's not so good. That's why if you go out to New York City, and sometimes you'll see a picture or a video of like a golden looking bull, and it's on Wall Street outside the New York Stock Exchange. That's why it's there. It's the bull market. Okay, so the next thing I want you to do is to understand a few things. Now, you can click on this here link, which is right here, and this will give you kind of an idea of what's going on. Now, there's a couple things you need to understand about the stock market and whatnot. Now, stocks, what is it? We've talked about it. It's a share of ownership of a company. So when you buy a share of stock, you're buying an equal share of ownership of a company. So if you buy 100 shares, you're buying 100 shares of stock, which means you get that 100 votes. Now, remember, there's probably potentially 2-3 million shares of stock for a given company. But that's what it is. All right. And then the value of that company goes up and down. And what happens, and it's true supply and demand, the desirability of having that stock goes up or it goes down. So if a company's doing well and people think it's going to, what we call pay a dividend, meaning it's going to pay its owners back a percentage of the profits, people want to buy that. And so the more people that want to buy it and the less it's available of people selling it, the price is going to go up. So when you hear about the stock market going up, it means that there's more people buying, or there's less people buying and more people buying than there is selling. Supply versus demand, more buyers than sellers driving the price up. Okay, and people want to get in on some of these things. That's what drives it up. And vice versa, if a company thinks this stock or a company isn't going to do well, they start to sell it. And if there's more sellers than buyers, obviously that drives the price down. And so when you hear things going on in the world, such as this COVID-19 or bailouts or all that kind of stuff, that's what you have going on. There's the people are saying, oh, things aren't good. I got to get my money out of there, so I have it. Or, oh, this company's going to go in the tank because of this situation. So that's what's kind of driving it. Now, there's more to it than that, but that's kind of what's going on. Okay. Now, the thing about it is, you can do something called buying on margin. And usually I draw a diagram, and I might make a diagram a little bit later on here, but basically the way it works is if I want to buy on margin, it means I'm going to take a loan. And your margin is basically how much you invested and then how much you've gained. That's the whatever your profit is, that's the margin, more or less. And basically when you buy on margin, that's saying, all right, I'm gonna buy $1,000 worth of a stock. But I also want to buy more than that, but I've got $1,000, so I'll buy my $1,000, but then I'm going to buy the rest on margin, meaning when I sell it, I'll take the rest of it out of that. Okay, so if I buy it at $1,000, But say I buy I put $1,000 in, but I buy $2,000 worth of stock. That means I've got $1,000 in, and I've got another $1,000 on top of that are in. So I've got $2,000 worth of stock now. Okay, if the stock goes up to 6,000, when I sell it, well, I get my 1,000 back. Plus, I have to pay back the 1,000 I borrowed. So my net gain on that is about $4,000. Okay, so as long as the stock goes up, buying on margin is great because I can buy more than I would have. Okay, because think of it this way, it goes up 3 times. So if I bought that $1,000, I would have made it would have gone up to 3,000, and I would have had $2,000 that I made. But by investing $2,000 on margin, I went from $1,000 or essentially $2,000 to $6,000. Well, that's a $4,000 gain. All right. Which is obviously better than a $2,000 gain. It doubles my money. So it's a good thing as long as the market goes up. But if the market goes down, I've got $1,000 in that I actually put in, plus I owe $1,000. So if it doesn't go anywhere, I pull my $1,000 out that I had, and now I got to pay back my loan of $1,000. I'm down to no dollars, right? Like I said, I'll do a visual sometime here, but that's what's going on with buying on margin. You got to watch out for that stuff. And of course, advertising is going to help increase the sale of things. Is this next part down here? And halitosis, we're not going to worry about that right now. Although halitosis is bad breath. Why would people be afraid of having it? Long story. Anyway, what I would like you to do, though, is kind of take a look at reading through this. And it'll give you an idea of what was going on during that time. Now, if it gets a little wordy, you can kind of skim it a little bit. But it gives you a pretty good idea of what was going on. Now, here are some questions. You do not have to turn this in. There's a quick check down here. You can do it if you want. You do not have to turn it in if you don't want to. I'm not going to make you. But I do want you to have a little bit of an understanding of what was going on in the 1920s as far as the market, especially as you work on this project where you're comparing to today's economic situation. Are we in the same situation? You know, you might be surprised. Yes and no. So, all right. There you go. We'll talk to you soon.